Okay, let's get started. So good morning, everyone. Happy New Year. I hope you all had a very restful break. Although if the start to your year has been anything like mine, it feels like a bit of a dim and distant memory now. So welcome to the first in our spring series of enterprise webinars on employee incentives. My name's Esther Carter and I'm very pleased to be hosting you this morning. Over the coming weeks, you can look forward to lots more topics. Details are available on our website and obviously invitations will be sent out in due course. We're always open to ideas and suggestions about what you want to hear about. Obviously, these webinars are for you. So if you have any topics that you'd particularly like to hear about, then do email into your regular partner or into our general website address. So I'm sure most of you are probably familiar with who we are. There are lots of regular names on the delegate list, but for those of you who are less familiar, Moore Kingston Smith is a UK top 15 audit, tax and advisory firm. We work with lots of entrepreneurial businesses right across all different sectors, as well as not-for-profit organisations and private clients. We're also part of More Global, which is an international network with presence in over 100 countries. So today we're talking about employee incentives. And this topic has probably never been so important with all the disruption in the market and all the movement that we have seen over the last couple of years and the huge number of people that have moved, whether voluntarily or otherwise. In a recent survey that we carried out across More UK, almost a third of businesses said that recruiting and retaining staff was one of their top priorities for the next 6 months. And for most businesses, employees are your main assets. So making sure that you incentivise them in the appropriate way and ensure you keep the right people is absolutely vital. And done correctly, employment incentives will form part of both your recruitment and your retention strategies. And determining the right way to incentivise people is not always so easy, as different employees have different motivations and expectations. And as well, incentives can be financial and non-financial. So to talk to us in more detail about this topic this morning and how we can incentivise our employees, and also all the different sort of tax consequences that those incentives have, both for the employer and the employee, I'm delighted to introduce two regulars on our panel, which many of you I'm sure will have heard from before. So we have Richard Cummings, a director in our HR consulting business, and Tim Stobbold, one of our tax partners. Well, in fact, head of tax, in fact, I should say, not just one of our tax partners. A little housekeeping before we start, please do. It makes it much more interesting if this is interactive. So ask questions as we go along, and I will put those to the panelists. Please do ask them in the Q&A function, though, rather than the chat function. Much easier to keep track of them in the Q&A function. We're recording this webinar, so we'll be sending around a recording afterwards. So please do share that with your peers and anyone who has missed this morning and wanted to come along. And at the end of the webinar, you will be directed to a feedback poll. It's really short and quick. Please do fill it out. It's really useful in helping us to shape our future sessions. So Richard and Tim, you can turn your mute buttons off. So maybe coming to you, Richard, first. So incentives, I mean, as I mentioned, they could be financial incentives or they could be non-financial incentives. And I'm sure, you know, the phrase financial incentives, it's a little bit more obvious to people what we mean by that. But what do we mean when we're talking about non-financial incentives?
Yeah, it's quite interesting, actually, because some people kind of mix it up a bit. So when people say we have lots of non-financial rewards like parking spaces, well, actually, that is a financial reward if you offer free parking and if you offer training and stuff like that. So generally speaking, anything with a monetary value is a financial reward, and anything without a monetary value is a non-financial reward, which makes perfect sense, obviously. And but anything with that cash incentive. So I think when you think about non-financials, they are important. But there is a difference between the two.
Good. We had somebody quick off the mark here with a question. I was just pondering whether to ask this question now or to save it up. Let's go for it. What are the tax implications for both employer and employee in allowing employees to work remotely overseas? I suppose that could be classed as a non-financial incentive, couldn't it? Allowing people flexibility in where they work.
It definitely is, but it's definitely a Tim one because this is the tax.
Well, I mean,
lots
lots of overseas jurisdictions have had a great time during the COVID years of advertising themselves. I know Antigua, there's a whole industry in Antigua in providing people accommodation and allowing them to work out there, and it's incredibly tax efficient. The question, what are the tax implications for the employer and the employer? Well, many, and it's a whole session on its own. For the employer, we need to just be cautious that we're not creating some sort of taxable presence in that other country, because doing the right thing by an employee could create a complete compliance nightmare for the business. If let's step away from Antigua for a minute, let's choose France, somewhere that's definitely not a tax haven. Having a permanent establishment in France that's a taxable presence can create all manner of headaches on local corporate tax liabilities. For the employee, the basic rule, if they're going for any more than a relatively short period, let's say more than 30 days, they're generally going to have to consider some sort of local tax and social security payments as well. And the killer there, and it depends from jurisdiction to jurisdiction, is they might be incurring an employer's social security liability. And whilst we might think that the UK employer's national insurance is high, it's a complete bargain compared to the rates in Europe. So tread with extreme caution. Don't say yes to employees until you've gone off and figured out the tax, and come to me directly if there's any particular jurisdictions you want to hear about.
There is a point. There is a point here about the. Sorry, go on. Sorry, I was going to say about the whole flexibility thing, because actually it is a non-financial reward, allowing people to work flexibly, but it does have a monetary value to them in some sense, because right now recruiting is ridiculously hard, isn't it? And as anybody knows, that actually everyone's trying to grab the best talent and certainly trying to retain what they've got. And allowing flexibility and allowing people to work remotely is obviously a big thing at the moment. Some people do want to work from home. We've talked about this extensively over the last 2 years, but there are jobs now that I've looked at where people are advertising jobs saying can work remotely, can work flexibly, can work anywhere in the UK, and it is a big thing. So it's almost made like every job's a London job, so it's made it much harder if you're in London trying to recruit in London, because there's someone who could live in Manchester and get a London salary working from home without actually having to commute at all, or minimal commuting, like one day a month or something like that, to see their team. So, but it's about whether or not you do it, how you do it. Do your employees want it? Does every employee want to work from home? Because no, they don't. And it's trying to work that out as well. But I think this whole flexible working is a big, big, big factor here, including working abroad and all that sort of stuff as well.
Yeah, and what I was going to say is actually we did have a session on mobile working back in maybe the beginning of December. So that will be still available for download via our website if you're interested in going to that to find out a bit more about the detail there. So we're talking about non-financial rewards. How important, Richard, are non-financial rewards as part of the incentive mix?
Yeah, it's incredible. And so we all say that, well, I've said it all the time, people don't really leave companies, they leave managers. And it's incredibly important to ensure that managers are well trained, so that actually they G people up. Every employee pretty much wants to be told they're doing a good job. They want to feel like they're doing rewarding and interesting work. And lots of people, when you look at the stats of why people leave, they say that the job just doesn't do it for them anymore, and they want to be challenged a bit. And that's why they go on to somewhere else that's going to do that. And they want a manager who's inspiring and who's good to work for, and it's an enjoyable team to work with as well. All that stuff really matters. And if you work really, really hard, and we all know if you work really hard on a project and you deliver it and it's a great success, you want to be told that you've done a good job. And if your manager just thinks, well, that's just your job, you should have got on and done it, that's what we paid you for, it's probably going to have a negative impact on your workforce, and you're probably going to be out the door. So, but it is this whole morale thing that's really, really important, and we're seeing that more and more now as well. I've talked about this post the pandemic. People have felt a bit doom and gloom. Work hasn't really inspired them much. It's been very mundane. They haven't been told what a great job they're doing, and now they're looking for the next challenge and they're on their way out. And so I think that non-financial reward, that motivational aspect, that good management aspect is incredibly important, because you can throw as much money and as you want at people, but if fundamentally they're unhappy because they don't like you, they don't enjoy working for you, they're going to go.
I guess at the moment, obviously a lot of people are having to work from home, but going forward, people keep that as part of their flexible working package, that could be considered as a non-financial sort of perk, reward, the ability to work from home. And I know we always get lots of questions, Tim, on the tax sort of side of working from home in terms, and we've got a question coming here. So if you had working from home as your contract, and the questions we tend to get are, then when you do travel to a client or to head office, can that be claimed as an expense, or does that still just get classed as normal course of work?
This is a deeply unsatisfactory part of the tax system at the moment. So I'll give you the revenues view, and then I'll let you know what's happening behind the scenes. So the revenues view, in all of their guidance, is still stuck in the 1950s, that people turn up to a factory, they punch in, they only do their work at their workplace, and then they go home again. To the extent they work at home, that's a choice. There are facilities to allow them to do their work in an office, and therefore the home to office travel, if it's reimbursed, is in almost all cases viewed by the revenue as a taxable benefit. There are some stupid examples in the revenue manuals. I think sorry, not stupid, but slightly obscure. I think somebody who's training guide dogs for the blind can only train guide dogs in a home environment, so they're allowed to work from home and that's their workplace. So a valid example, but so obscure that doesn't really have wider application. So at the moment, even where you've got people working from home substantially all of their time, even if they haven't got a desk in the office, the revenues view in many cases is the reimbursement of that is a taxable benefit. Behind the scenes, everybody accepts that's fairly absurd, given the way that working practices have evolved so quickly over the last year. And the CBI, the CIOT, the Institute of Tax, are all lobbying government to say, look, you need to reform the travel rules and make sure not just that the law changes, but the revenues guidance changes. So at the moment, very carefully and cautiously, you could have a reimbursement of home to work travel, and you need to make sure your contracts and your policies all worked, and ideally there wasn't a desk for the employee to work at on those days when they're working at home, which is true for many businesses now. But it comes with a degree of risk. I would have thought in the spring, when we get the spring budget, I'd hope all the lobbying that's going on right now would equate to some change in the rules, so we might get a bit more clarity in a couple of months.
Thanks, Tim. So we talked a bit about non-financial awards. So coming on sort of to financial awards and the forms that these can take. I mean, Richard, presumably we're sort of talking about things like, obvious things like bonuses and pay rises here in the financial awards section.
Yeah, that's right. So we are talking about that. So we're talking about the different types of financial incentives that you can offer people. So really it is their salary, isn't it? It is the bonus structure. Like what is a bonus structure, and why do you have it, and what should it do, and how do you create it, and is there a off-the-shelf template that you could use? There's lots of short-term incentives, there's longer-term incentives as well. There's all sorts of things that you can throw at your employees, but really there's the other stuff, like the things that employees want as well, which is still a financial reward because it's still got a monetary value. Things like increased holidays. And actually that's become much more the norm. So the government minimum is 20 days holiday plus the 8 bank holidays, or 9 as it is this year, which has thrown a complete spanner in the works, because if your contract says that you get 8 bank holidays, then you're only getting 8 and you don't have to give them the 9th, even though it's a public holiday. But if your contract says that they get 8 plus, or they get the recognised bank and public holidays, they get all 9. So you're creating a bit of a headache there for yourself, just because the government decided to give us an extra one, which is nice for some people, but not everyone's going to get it. Anyway, so the general is the 20 plus 8, and so 28 days holiday for employees. Generally now in most sectors, 25 has become the norm. So most people would want 25 days holiday. In other sectors, it's a lot more. I think the ability to allow employees to buy more or sell as well. So if you're over the minimum, so if you're over the 20 plus the 8 bank holidays, and you offer 25 days, you could actually offer your employees to sell 5 days back, because they might not want it. Maybe holidays is not something that they really want, or it doesn't float their boat as much as other people, or they're part-time, so they've got too much holiday as it is. So as a pro rata amount, selling some back would be good for them because they'd get the money, and or the ability to buy another 5 days and have 30 days holiday. And actually it is proven that it does motivate people. It's proven that it can actually reduce absence levels. People get burnt out, don't they? So if you allow them to buy some more holiday, then actually they might not go sick. And that brings me on to another one, which is things like sick pay. I know that the generally, SSP is it's archaic. So I think it 100, it's not even that, is it? It's about 80 quid a week or something like that for a full-time employee if you go off sick. So most people would expect to see an enhanced sick pay. I know I'd like to see things like income protection scheme. If I was going for a job, I'd like to know that actually if I'm going to be diagnosed with a long-term illness, that I'm going to be protected somewhere. So that again is a financial benefit, but it's relatively, as Tim would tell you, it's relatively cheap to put in. And at these, and Bupa and private healthcare, enhanced pensions. There's obviously people have auto-enrolled now because everybody enrolls into a pension. That's just the norm. But actually, do you enhance pension or do you pay their contribution? Is there more things that you could do around that so that people say, actually, this looks like a good company to work for? And when you think about the list of things that you offer and you say, come and work for us because we offer flexible working and we offer home days, or we offer duvet days, which used to be a thing and they've gone down a bit now, haven't they? Because you don't really get them so much. So a duvet day where you just fancy taking a day in bed and you're going to take the day off work, and that's acceptable because that's the industry you work in and it's okay. And if you have this whole list of things that actually you're offering people, it's all pretty much going to have a financial to it, and it's going to cost you something. But actually, is it enough to make people want to join? And will people look at that list and think, oh, I don't know if I fancy that? So if you say we offer 21 days holiday, which is above the government minimum, is that enough to make somebody who's currently on 25 join your organisation? Or really, if you say we offer a flexible holiday package where you can buy and sell holidays and you can get up to 30 days, or you can sell holidays back, is that whole suite of stuff there going to be enough to get you to attract people to your organization? It's how much is that suite of stuff going to cost you? Is it really practical? Can you give everybody 30 days holiday if they all wanted it? And really this brings you on to kind of core benefits, flexible benefits, total reward package. What is that all worth? So there's a monetary value for the salary, so you're on X amount, and then you get all of this stuff as well, which has a value to it. But not everybody wants all of it. So can you be flexible with it? Can you say, well, actually, you don't have to have all of this, you just have the stuff that's important to you. So you select the benefits that you want as an employee or as an individual, and then we put a monetary value on it. So maybe you have £2,000 worth of benefits that you can spend every year, and where do you want it? There's all sorts of things you can do, and what you can't do as an organization is just keep throwing money at people. And right now the economy's in such a peculiar state that there's all these jobs, inflation's going through the roof, so people want more salary because things are getting more expensive when you go shopping and stuff like that. And then there's other companies throwing money left, right and centre at people, so you've got to try and keep up. So this is why the non-financial thing is so important as well, because people have got to really want to work for you. They want to stay with you. It's not that they feel like they're pressurized to do it. A bit of peer pressure with the team as well, and a good team environment always helps, because people don't want to leave their their colleagues. But you can't break the bank, and that's when I always talk about bonuses and bonus structures and stuff like that, because you can't give away what you don't have. But if you have a bonus structure that's linked to company performance, then actually you have got something that you can give when you've got the cash yourself.
Quite a few questions come in. A couple around holidays, in terms of what's the policy around not carrying holiday forward to the next year, and also how you price holiday.
Well, how you calculate holiday in terms of its monetary value. Yes, it's basically the day rate. So you take the annual salary, you work 260 days a year. So you take the annual salary and divide it by 260. That's the easiest way to work it out, and that gives you a day value of what the holiday is. So if someone wants to buy 5 days, it's 5 times that, and then you can pro rata that over the 12 months. Does that make sense?
Yeah, and then sort of around the policies around people being able to carry holiday forward or not.
Yeah,
and somebody's also asked about whether you can make people take holiday at a certain time of year as well, so you're less busy time.
That's right. So what the law effectively says is that you have to, if you want to enforce holiday, you can, but you have to give twice as much notice as the holiday that's to be taken. So if you want someone to take a week off, you have to give them 2 weeks notice. That's it. It's that simple. However, how that's interpreted by your employees when you tell them that, it's all in the messaging and the sell. But if you think about people that say, you need to keep 3 days for Christmas every year, between Christmas and New Year, we want you to take 3 days of your annual holiday. That's acceptable, and that's quite normal. So you are really enforcing holiday anyway. So you can do it. In terms of the carryover, it was relaxed slightly during the pandemic because people weren't able to take it. And they said that you could carry it over into the following year. But the general rule of thumb is that you must have your minimum. So you must have your 20 plus your 8 days holiday. So but anything beyond that, and actually it's a rolling year, so it's kind of open to a bit of interpretation, because so for example, if last year you didn't take your holiday, your first day of your annual leave wasn't until the 1st of April, your rolling year really, in terms of the government minimum, you must have your rest break of 28 days, is almost the 1st of April to the 31st of March. So you could roll over some of last year's holiday into this year, even if they hadn't taken the whole amount in the last 12 months. Yes, effectively you should have your 28 days rest break and then carry it over. But if you buy holiday and then you don't use it, there's no reason why you couldn't sell it back, for example, and get it back that way, or you could carry it over into the following year. What I wouldn't recommend is just allowing people to carry over holiday indefinitely, because I years ago I was an HR manager for a firm, and when I joined, everybody had been doing this. There were people having like 60 days holiday, and they were carrying over from year to year to year, and then when they resigned, they were getting huge amounts of encashment for the holiday that they were owed. So I would try and encourage people to take it. It is important. People do need to take a break, and they do need to take a rest. But yes, you can enforce it, and you can allow people to carry it over.
So a question that's coming here, so for a particular person that's allowed, well, they're closed for 2 weeks over the Christmas holidays, normally they give people the 3 days off at Christmas for free, but they've enforced things to shut down for 2 weeks across Christmas holidays, so presumably they can take that out of the holiday allowance rather than it being even more generous Christmas holiday they're giving people, as long as they gave them the notice.
Yeah, as long as they give them the notice, that's right. So this is really common in manufacturing, where plants shut down for 2 weeks in the summer, and it's just the general, you are going to take 2 weeks of your holiday over this period. So yes, it is doable. And it's the messaging though, because what you don't want is people to leave because they feel like they've had their flexibility of their holiday removed. Because really people like, and if you're a teacher, you accept that you can only go on holiday certain times. But when you work in certain industries, you feel like there should be some degree of control over when you want to go on holiday. And it's been quite difficult in the pandemic, let's be honest, because people haven't really been able to go away. So this is a bit of an anomaly the last 2 years, but as we head back to whatever normality is, you've got to think about how that's going to be received with your employees. It's a positive messaging, all the positive messaging.
And somebody's asked, is there a standard figure that people invest in employee benefits? I mean, you mentioned sort of a figure of two grand per person before. Is that sort of a reasonably average figure that people use? Or does it vary quite a lot?
It varies considerably around the organisation, what you've got, how much money you have, exactly what the norm is in that sector as well. So but if you start looking at what you offer, what you could offer, and put a monetary value on it, and then see, and that might be too expensive, when you start adding everything in, and then it's all about balancing the books really. So there's an element of giving people what they want, and rather than, I use gym membership as an example all the time. If you gave me gym membership, it would be great, but I wouldn't go. It would just gather dust, that pass, but I'd have gym membership make me feel quite good. So that's a cost that you've spent as an organisation that isn't being valued. But if you said to me, well, actually, the gym memberships cost us £200 a year, that £200 you could spend somewhere else. You could have that £200 put into your pension, for example. Then that would probably be more of a viable option for me, I think. So it's about what you have and about what you can move around and stuff like that.
And then, I mean, somebody's asked a similar sort of question really about employer contributions to pension schemes. Is there a level, you sort of talked about 25 days holiday being competitive on the holiday front. Is there a sort of a level of employer contributions that now is a competitive level? Or does it vary sort of depending on what the industry is?
It varies, but I think depending on your age, depends on how much you value it. And I know that certainly when I was 18 or 20, the pension contribution was just, I didn't really value it or think about it. So if you'd said to me, we're going to put £10,000 into your pension every year, I'd have probably said, well, I'd rather have that cash, or I'd rather have that somewhere else. But at my time of life, and I appreciate I look a lot younger than I am, and the having that extra amount of money put into my pension actually does make a difference. And I think really you probably need pensions advice on that to see what that translates to as a pensionable amount in the future. And it, as Tim says, that that 25% of that can be taken as tax-free as it stands today, and so that might be, the closer you are to retirement age, the more of a benefit that is. But the government minimums are quite low, like the 3% and the 5%. Whilst that seems like a sizable amount of a salary, if you're on 25 grand a year, that's not a lot of money. And if you do the maths and work out what it's going to be in your pension, that isn't a huge amount. So adding on to that could be quite beneficial, depending on your age, I think, really.
There's an enormous advantage. You're paying for a pensions advisor probably, and invite them in, get value for money to come and do a after hours session, maybe with a glass of wine as well, to tell your employees what the pension's all about, because very few employees understand their pension and know whether they're ever going to be able to retire. In that same session, they can make sure they communicate the value of what the employer is putting in by law, to actually say, this is brilliant, the employer is putting in not just the 3%, but possibly a bit more. And also the pensions advisor can really stress how important moving the employee contribution to a salary sacrifice contribution is, because that works best all round. Everybody gets the tax relief they're entitled to much sooner. Employers, national insurance is saved. So I wouldn't just let the pension be a sleepy thing on the side. I would actively engage with your pensions advisors, ideally get them in. The only way you're going to encourage your employees to come and listen to a pensions advisor is probably providing them a drink and a biscuit afterwards. So a combination of that would be a good idea.
And I think employer contributions also tend to vary depending on the level of seniority of the employee. The more senior they are, the more percentage contribution.
Generally that's linked to age, isn't it? So because broadly speaking, the more senior you are, the older you are. So and really the people that are older, the ones that, and the more senior, the ones that make the rules. And so pension is like to them, that's a big highlight, isn't it? But I know in my 20s when I had friends who were working who were saying that 10%, the company pays 10% contribution and stuff like that. That's probably great, but the really 10% was probably not a lot. Their salary was probably quite low. So as a percentage, they were saying it was high, but as a monetary value, really, for the company, it wasn't a huge amount. But it sounded better than it was, I think. But it was a good carrot, and not good carrot. It's a good tool to keep people there.
Yeah. Obviously, pension schemes have a slightly different tax analysis, Tim, don't they, to other financial benefits? It might be worth at this point just talking about the tax efficiency of the financial benefits that we've touched on.
Yeah, well, I'll rattle through a few that we're talking to clients about at the moment. So we'll skip over bonuses. We've touched on those a little bit. Bonus schemes are the simplest and best understood thing, but not very tax efficient. Tax efficient things, going down my list, I came across a recruitment business a few years ago that offered their employees at pretty much every life event, moving house, having kids, getting married, lots of interest-free loans. I think they'd listened to their employees, and the stretch on cash flow was something that was difficult for them. So provided you've got some confidence your employees can pay you back, and levers are a problem there sometimes, but loans can be made to employees of up to £10,000 at any given moment without a taxable benefit arising, and it's a good way of locking people in, because the loan's immediately repayable on leaving, but also there's a lot of goodwill you generate with your employees on helping them through those life events. So quite a fan of interest-free loans these days. I could make 2022 my year of the electric car, and Esther knows this, I've been banging on about it for a while. The government in trying to move people away from diesel and petrol and into electric cars have created the most phenomenal tax regime for them, for the business and for the employee. So we've all gone off company cars because we were all conditioned to know that company cars were very tax inefficient. You were paying tax through the nose, but the tax regime applicable to electric cars is very good. So if you have an electric car, the benefit in kind right now is only 1% of the list price, rising to doubling to next year to 2%, but it plateaus around 2% for a few years afterwards. So if you said to your employees, and this can be done under a salary sacrifice scheme, one of the few things that still can be, if you want to give up £500 a month from your salary to lease an electric car, you can pay for your electric car out of your gross income. It will be a benefit in kind, but you're only going to pay a benefit in kind on a very, very small amount. The people who know more about the taxation of electric cars than me are the people who work in the garages, because they know when they're selling their electric cars that this is one of their major pushes. If you facilitate your employees moving from a petrol car to an electric car, you can also wrap that up within your ESG credentials, that you're helping employees move into a more environmentally friendly way of traveling. I have seen that done badly, where a company took that route, but it was only the board of directors who all got themselves a new Porsche Taycan each, but didn't extend the scheme to anybody else. That was badged as an ESG move, but wasn't accepted very well by the employees. But electric cars will be very popular this year for employer provided vehicles. Mobile phones, pretty standard. Employer provided mobile phone is a tax exempt benefit. Employer provided training many years ago, Moore Kingston Smith provided Spanish classes, not because we had a lot of Spanish clients, but a lot of our employees wanted to learn a foreign language. So after hours, we had somebody come in for an hour a week for a few weeks to teach Spanish. And employer provided training is a very broad exemption, as long as there's some incidental, possibly esoteric link to the job, it can be provided as a tax exempt benefit. We've got the tail end of the COVID tax exemption. So if your employees are working at home and want a desk, a chair, bookcase, whatever it might be, all of that can be provided to an employee as a tax exempt benefit. Right now, that exemption is due to end April 2022. So in, what's that, 3 and a bit months, it may be extended again. It's already been extended once. But if you are moving towards that more hybrid working, the ability to kit out your employees' home offices for another few months without the employee incurring a tax charge is quite good. The £6 a week won't really cover because it's a bit forgettable, but do remember you can pay £6 a week tax-free to any employees working from home. So those are the sort of basket of tax exempt benefits before we get on to tax efficient stuff like share schemes and things in a bit that are quite easy to do and popular, especially the car ones, because everyone loves cars.
I'm going to just jump on this electric car thing because I think it's really good, and I think as a benefit for employees, actually, it's phenomenal. And when you think about how much they spend on cars anyway, but actually, it's the tax efficiency bit. But for the company, it's really good. I was looking at one of them, and I was looking at one of them with a client, and they said to me, we're really worried about our employees. If our employees leave, what's that going to do? Are we going to be lumbered with this car? Well, actually, some of the schemes that are out there don't worry about that too much. You can just hand the car back, and there's no liability on the company. So the risk is actually becoming smaller than it was. And it's a great perk. And it's, Tim's saying about £500 a month. Some of them are much lower than that. We're talking like £150 a month to drive an electric car. And I think and what as well is about the CSR bit, so the corporate social responsibility. A lot of people now, particularly the next generation, they want to know, what are you as a company doing to help the planet? What are you doing, and what are you doing? What's your take on people? What's your take on environmental? What are you doing around that? So this really, really, really does help in that area. And so I really would, if you take away anything from this, I would seriously look at electric cars as an option. If you live in central London, it's going to be quite difficult, but it's still a doable thing, isn't it?
Somebody's asked, does electric cars include, or does the electric car tax scheme include hybrid?
It does, and without sort of looking up the numbers, there's a CO2 emission that you have to be below. I think it might be. I won't guess it because I'd have to look it up in the book. But some hybrids I think do qualify, but it's largely directed towards fully electric. Get yourself a Porsche Taycan. It's effectively half price if you're a 45% taxpayer. You're getting a car half price, but I shouldn't encourage that really.
No, I looked at that. It was about £800 a month, but I quite like the £150 a month was a bit more appealing to me. But it is, and actually, I was looking at it as well because I was thinking, I live quite away from the office, and I think I couldn't get an electric car because it wouldn't do the miles, but actually they do. So this isn't the electric car seminar, but
that will come later in the year. Right. Moving on, Esther. Sorry, back to you.
Moving on. So somebody's asked, is there a way that the company could provide private medical cover without it being classed as a benefit in kind to the employee?
No, only
news
for. I think there's a specific exemption. I'd need to look it up for private medical that only covers you for overseas business trips. I think that can be an exempt benefit, but your everyday private medical, no. For very large employers, this is again a bit off topic, for very large employers, so with thousands of employees rather than tens or hundreds, there's a trend to self-insuring your private medical, where you, instead of paying an insurance company, you actually pay money into your own trust, and that can have enormous savings, but it only works if you've got a very large employee base, because otherwise one claim could kill the whole scheme.
Yeah. I think there might be a slightly more positive answer to this question, because you touched on the Spanish lessons before. Somebody said that given the skill sets of people need to be kept up to date as roles shift, how can education provision be structured as incentives to retain staff?
Yeah, I mean, well, first of all, I think we come onto this perhaps a bit later if time allows. Find out what your people want. That's where the Spanish lessons came from for more Kingston Smith. But employer provided training only has to have some either link to the job or would enable the employee to do their job better. So, employer provided training that improves the confidence of the employee, which could be nothing related to it. It could be rock climbing course, whatever it is. If it improves the confidence of the employee, it better qualifies them to do their job. So the employer provided training exemption has forever been viewed as very, very generous. It encompasses almost anything. I might be exaggerating a little bit, but there's not much I've come across that wouldn't be included. And then, to within reason, done carefully, that's a social element as well. One of the great things about the Spanish classes we did is it got a whole load of people in our business together who wouldn't normally see each other. And when everybody's working remotely, I mean, we've had I think something like 20% of the workforce, I think, for us have joined since lockdown started. There's a number of people I could walk past in the street and not even know they work for us, which I find, quite a depressing thought. So anything which is the tie that binds, get people having those links through the business through other sort of means is great. So Spanish classes or anything similar, rock climbing, do that too.
Yeah, I think if Paul Samra was on this call, he'd be, he's a regular as well. He'd be talking about well-being and stuff like that, and this does all feature. But again, from my point of view, it's almost something that's a bit more sticky. I think as an employer, it's great if your employees say it's a great company to work for because of X, and if X is, they gave us all Spanish lessons. Great, it's cost negative.
Other languages are available.
Yes.
Other languages. Well, yes.
So we've talked a bit about sort of determining what employees really want and how important that is. Richard, talk a little bit about how do we go about determining what it is that employees really want?
Yeah, that's right. So one of the worst things you can do is just assume that all your employees want the same thing, because that's not the case. And doing a survey and finding out what people want, I think that's great. But I think people have been surveyed out over the last 2 years. One of the problems is that I know that, and I go back to my gym membership thing again. You do a survey now in January where everyone feels a little bit bloated after the Christmas holidays, and you say, would you like gym membership? Most people are going to tick yes, but like me, never use it. So you assume that that's what they want. And don't get me wrong, there are people that do want gym membership, of course there are. But really, I think trying to find out on an individual level and doing some workshops with people, trying to see what is available, saying that this is the stuff that we've got. Do you value it? How do you think if we got rid of it, you would care? Do you think if we kept it, how do you feel about that? And then almost drilling it down to almost a personal level, and then working out on a demographic basis as well. But then that draws me back to the flexible benefits as well, and about having the total reward package, and that really, if all of this stuff's available, who wants what, and then they cherry pick what they want. And having that stuff available is great. But really, if it's gonna, if you're gonna bust the bank just getting it there so they could pick from it, then think about it really seriously and ask your employees. But don't think a survey is going to do all of it, because it won't. I think you need to drill down a bit further than that.
Yeah. Well, while we're talking about surveys, I think now is an appropriate time to put our little poll up, which is to see how well do you all know your employees, and what do you think would be the most popular incentive with employees? I think you can just choose one. And Kirsten, I'm assuming you'll take it down once we've had a quorate number of people vote. Super, right, there we go, there are our results. So financial incentives is what people are, almost half of you are going for, and then quite a lot on sort of the whole flexi time, home working and increased holiday. Richard, what are they right?
Well, it's funny because employers always put increased salary. That is the employer view, that people want money, and employees don't always come up with that. So higher salary is a reason for leaving, and there's always going to be companies that are going to pay more, because there will be, and they'll always find a bigger salary somewhere else, especially at the moment, because it's so competitive. But that's not the only reason. So one of the big reasons why employees go is they want a more challenging role. So you can throw as much money at them as possible, but if you don't get that non-financial bit right, it's not going to work. But yes, but what we are knowing is that over the last 2 years, when we surveyed employees, the top things they've asked for is more time off and more flexible working. And historically, prior to the pandemic, we've said, well, we get you want flexible working, but we can't really offer it to you because we don't know how to. And we've been in a position now where we've actually said, well, we kind of it was forced upon us, and we've offered so much flexibility that now it's hard to take it away, and people want more flexibility. And there's last year there was a factory in the West Midlands who decided that they were going to shut Friday, and they shut on a Friday, gave their staff effectively 52 days extra days holiday a year. And in an industry that really can't operate flexibly or struggles to operate flexibly, and they've reported that their productivity's increased, and they've got their workforce working 20% less. So really I've said this before about loads of other companies as well, and I talk about Ford and Heinz as an example, that when you give people what they want, they tend to stay, and you get more people wanting to come and work for you. And right now it's flexibility and time off that people are after. If you can somehow achieve that, you've got a more chance of retaining people. It won't pay the mortgage, because they will want higher salary at some point, but that could be that actually a combination of bonus structures and other financial benefits. And if we think about, we talked about working from home and flexible working as being non-financial, but I know my season ticket was £7,000 a year. And so for the first year of lockdown, I saved £7,000. If I was suddenly now going to hunt back into London, that would cost me £7,000. So the mindset has completely shifted into I'm saving it to I'm spending it. But salary is going to be a factor, but don't think it's the big one and the only one.
Yeah. So you're saying that actually when employees were asked, time off and flexibility rated higher,
much higher
incentives such as pay rises.
Yeah, that's right. And I think one of the things that we do is when we say to people, why is it you're leaving, and we ask, they don't always tell us the truth. So people say, it's more money and stuff like that, and then you throw more money at them and you do a counter offer and they still go anyway. So it wasn't money, it could be you as a manager. They're unlikely to tell you that they're going because your face is on their dartboard and they just can't work for you any longer. There's all of that stuff. So the surveys you need to take with a pinch of salt, but there's been lots of them that have been done over the last few years, and they are consistent with that time off and that flexibility.
Somebody's asked, can you link flexibility and more holiday to performance? It's quite an interesting one.
That is an interesting one, but yeah, effectively, I suppose you could. So actually, there's a few firms that do unlimited holiday now, and you can have as much time off as you want. And there's, particularly in the media sector, I think Virgin were part of the Virgin Group, one of the first ones to do it as well, and they publicised that. But it is linked to, you do actually have to, you have to have it authorised, so you can't just say I'm not coming in next month, and you have to achieve all of your targets. And if you don't do your role effectively, then you're going to lose your job, because you couldn't just say, right, well, I'm taking a year off, because you've still got targets to achieve. So I suppose that actually, if you did give some targets to people and say that actually if you hit these these measurables and you achieve them, then yes, you can have some extra time off, or if you finish this early, you can have some time off. We used to do years ago, job and finish and stuff like that. I suppose that's pretty much that kind of thing. This is just rebadged for the 21st century.
Yeah, indeed. Somebody's asked about red letter days. Are giving incentives such as red letter days, like your Silverstone driving experience and things like that, or balloon rides, are they are there tax implications to the employee or the company of doing that?
Yes, short answer. So if you're giving them as a reward for performance, we can't sneak them into the trivial benefits exemption. So the trivial benefits exemption is the sort of the bunch of flowers on your birthday and maybe the Christmas drinks. But if something is a direct reward for performance, it can't be a trivial benefit, which otherwise allows up to £50 of value to be given to an employee. So if you're giving this as a sort of reward, but of course you don't want the employee to suffer tax on it, because you'll be giving with one hand, taking away with the other, you would put that into something called a Paye settlement agreement, a PSA, which is where you, the employer, chooses to pay the employees tax on their behalf. And it's a very sort of, well, say slick, reasonably slick system that once a year you add up all the things you've done to the employees, for the employees, which will give rise to a taxable benefit that you don't want them to pay tax on. So certain social events, drinks, food, red letter days, you put it in your PSA at the end of the year. And you know, the arithmetic of what tax is payable under a PSA, because there's a grossing up, is whatever it cost you as a business. You've probably got as much again to pay in tax. A PSA liability is generally double the cost of the benefit. So you've got to think, if I'm doing that, I know there's an additional cost to the business. Is the benefit that I'm getting back from it worthwhile?
Yeah.
You got to see whether or not red less days are what they want as well, because if someone bought me, you know, a drive around Silverstone, I couldn't think of anything worse. You know, it wouldn't appeal to me at all. And, yeah, or a parachute jump, you know, falling out of a plane at God knows how many miles an hour. You know, it might not appeal to everybody. And I think it's that I guess the good thing of red less days, right, as an example, is that actually you can choose which one you want, I think, can't you? And out of a whole host of things. So that is quite flexible in itself. But those kind of, I think you'll be really careful with what you give people and what you see the value of it, because generally we give what we would want. So if you give somebody a bottle of wine as a well done, you know, they might prefer a hamster because they're just in a different place to you. So I think it's got to be aligned to what they're after, because it's not a motivator. And I use the example quite a lot about an ad agency I worked with, and when they first got, you know, they first incorporated, they were all very young and they all went to the pub all the time, and they went for weekend retreats and holidays and stuff like that. But as they got older and they got married and they had kids, they didn't want to do that anymore. So all of that, if we hit our target, we're going to Marbella for a weekend, didn't motivate them. In fact, if anything, they didn't want to go. They didn't want to say they didn't want to go. So it had a more of a negative effect than it did a positive one. And the leadership team hadn't really evolved as the organization evolved. So I think you have to change with your demographic, and you have to change with the times, really, and what people are after. I don't think just because you always gave everybody a bottle of wine at Christmas and it worked, you think that's going to work forever.
I got a generous gift from a client of a case of wine just before Christmas, and I walked around the office trying to give the bottles away to people who were just in the office. Very difficult to give them away. Nobody drinks anymore. Yeah, how times have changed. They were quite nice wines as well.
Again,
I don't know. We've 12 minutes to go, Esther, and we haven't touched on some of the longer term incentives. Should we?
No, we haven't. Yeah, let's move on then. So yeah, we have this sort of nice 4-box grid model that we use when we're trying to sort of categorize employees and think about what incentives might be appropriate for which employees, and to distinguish between short-term and longer-term incentives. Richard, did you want to sort of just talk us through this, and then Tim perhaps sort of touch on some of the sort of the longer-term incentives and the tax benefits of those?
Yeah, that's right. So it's quite a simple tool, really. It's, you know, you shouldn't really put your employees into boxes, but this is an easy way to do it. And if we look at the top right hand corner, we have our superstars. So these are the people that we really, really need in our business. They're high flying, they've got a lot of commitment. They're going to be here for the long term, and we want them to be here, and we want to keep rewarding them and keep motivating them to stay. And then if we look to the bottom right, we've got the core team. These are really the people that they're good. They're a stable employee base. We want to keep them. We want them to stay with us because they've got all this knowledge and experience and stuff. But they're not going to set the world on fire. They're not going to do anything revolutionary. But without them, we would struggle. And they are replaceable. And then in the top left, we've got our nomads. So this really is a lot of the next generation falls into that category. The people that will come in, they'll be here for a few years. We know they're not going to stay here forever. We know that they see this as a bit of a stepping stone, and they might want a succession of lots of short run jobs of a couple of years. And I don't think that's a bad thing, because we're going to get value out of them while they're here, and they're going to get experience as well. So it's a bit of a win-win, really. And whilst we would like them to stay, and there may be a chance that they move into the top right hand box, we wouldn't necessarily say that was going to happen. And then we have the bottom left, which is the transfer list, which is really the people that they may have once had a value to us, or they may have been really good once, and the business that they operate in doesn't really operate in that way anymore, or we've outgrown them, for example. And it's quite sad, but we've probably come to the end of the road. But if they stay, they stay, and they've got some transactional value, but not a huge amount. So when we look at rewarding them, they're going to be rewarded in all different ways, aren't they? So this top right hand corner, because we want them to be here for the long term, we're going to talk to them about long-term incentive plans, and we'll loop Tim in a second to talk about that, because this is his area, definitely. And we would talk about what actually they want, and what does that look as a long-term event. And that bottom right, really, we talk about the 2% salary increases every year, the bottle of wine at Christmas, all that kind of stuff will keep them happy, because that's what they're after, and that'll keep them here. And then we look at the top left, the nomads. This really isn't a long-term incentive plan. Is probably not worth paper it's written on, because they're not going to be here. So if anything, it's just going to drive them away, because they think that they're contributing towards getting this money that they'll never get, because they won't be around to see it. That really what they're after is, and I said this already, the next generation really want rewarding work that they're going to get value out of. And it's not necessarily about there are bonus structures in there that work for them, because it could work per job and stuff like that, but we are looking very short term. And that bottom one, really, we are talking about pretty similar to the bottom right. It's going to be the bog standard bonuses and stuff like that, but nothing to write home about. Tim,
I'm going to sort of jump into the top right then. So that the long-term incentive. So we have a lot of discussions with our clients about sharing equity or something that's like equity with their employees. Most of those conversations end up with some sort of share scheme. So as long as the share scheme is being provided to the right people, they can work incredibly well. Those employers that want to give allow their employees to participate in a share scheme, all the employees right down to the person that sits on reception up to the chief executive. I see little value in giving equity ownership to people who haven't got the ability to influence the equity. They won't value it. And as Richard said, if they're only here for the short term, it won't have the desired effect. It will just incur you some professional fees and won't reward or motivate those people. But at the top right, having some sort of equity scheme in place, and if you're able to, if you're a company and you qualify, an EMI, an enterprise management incentive scheme, is the share scheme of choice. It gives the employees an incredibly good tax position on the way out. Hopefully they'll only be paying 10% tax, and it gives the company quite a valuable corporation tax deduction. Now, I've seen a number of EMI schemes sort of fail to have the desired effect, and that isn't because the words in the agreement weren't put together correctly, but it comes down to corporate strategy and whether it's clearly communicated. If you put in place a share scheme that's going to pay out a load of money to your key team if the company sells in the future, you better have some sort of open dialogue with those key performers about whether the company will ever sell in the future. I've seen companies put share schemes in place, but all the employees say, well, old man Bob's run this company and we know it's going to his son, old man Jim, or younger man Jim in the future. This company will never be sold. So me having a share option that is only in the money if the company is sold is completely irrelevant. But on the flip side, if you have a clear strategy and communication with your employees that we're growing the company to this level, and then we're going to take that next step of selling out to a bigger organization that will fuel our growth for the next stage, that can really drive your senior management team forward, because depending on the point at which they come into the business, they've often got share options that are exercisable at a fairly low value. And on sale, all of that hidden value comes to the front and they will get their big payday. Purchasers like also the key management to be tied in with equity incentives, because then they can be bound into whatever deferred payments are due, earnouts and that sort of thing, so that they know the key management team that have been responsible for the growth and success of the company are going to be sticking around after they've acquired the company to carry on earning the deferred payments. So there's a whole, and it's another session in its own right, but it would have been remiss not to talk about equity incentive schemes alongside this. They are not the place necessarily to start. There's everything we've talked around, package as a whole and total reward. But for your top right, your superstars on the chart on the screen now, looking at something that gives them some value as the shareholders get value, I think is I'd say Esther on our client base comes up on almost all of them. And if you're unable to do share schemes, we're looking at things like phantom share schemes, which is just a bonus scheme by another name. But that's another way of delivering value, just significantly less tax efficient.
Yeah, absolutely. And I think the mistake some people make actually is giving equity incentives to the nomads and widening it out too much. And I always say to people, I think it's better to give a smaller pool of people a higher percentage of equity than to spread it too thinly where it becomes meaningless and not understood. Confine it to your senior leadership team, the people who are really going to help drive that business forward and whose goals you want to align with the founders' goals. And like you say, buyers of companies where the talent is key to the business, they will expect the senior leadership team to have equity incentives in place. And if you don't think about it early enough, then it loses a chunk of its tax efficiency if you're putting it in at the last minute, doesn't it, Tim?
Yeah, I'd say it's less often now, I suppose, but I'd say 2 in 10 deals, one of the conversations at almost the finishing line of selling the company is we promised Sarah, Jane and Paul some equity in this business, and we never quite got around to giving it to them. What can we do? And the answer is not very much, apart from pay a ton in tax. So COVID has made my share incentive team quite busy, because what it's done is businesses that are fundamentally sound and valuable can right now agree relatively or discounted share valuations with the revenue, because COVID's had a knock on their figures, and being able to agree a low valuation with the revenue right now does mean that equity incentive schemes are that much more attractive to the people able to participate in them. That may not be true forever, because the economy might be booming, but who knows? It's still pretty volatile, and we're still mentioning COVID in every valuation we're doing.
Somebody's asked a good question here. I mean, I don't think the answer is going to be as good as they might hope, but can you have an EMI scheme whereby the company buys the shares back, so it's essentially a tax efficient bonus?
Yeah, I mean, they do exist. It's not structured quite like that. If the company buys the shares back, the tax efficiency is largely lost. But having an EMI scheme with a sort of warehouse over here to buy the shares, which is often a trust, an employee benefit trust, works well. We've done that a number of times where the employees exercise and then can sell some shares into the trust. Of course, the only thing that can fund the trust is the company, so we're not conjuring money out of thin air. It works well. I think where it's been difficult is that if then roll on some years, the company's then being sold and the trust owns 10% of the company, that can be a bit of a pickle in getting that 10% out. So again, if you want that sort of structure where you're using an EBT, an employee benefit trust, as a warehouse for the shares, put the far-sighted spectacles on and say, well, what does that mean? Will we ever get to a point where all the options have been exercised and the employees own the shares, or are we going to be stuck with the trust owning some of the company at the finishing line?
Thank you. We are 1 minute from the end. I'm conscious there are a number of questions left, so what we will do is we will answer those questions individually or offline once we've finished. I think I'll just end on this question though, because I think it's a good one. It's around tips for maintaining the impact of benefits. They've sort of said, they find ex-gratia benefits are all very well received, whether it's a pizza or a bonus, but if you keep doing it, it becomes an expectation and therefore it loses its impact. So, how do we manage that?
I've said this for years. I say it's so easy to give stuff. It's so hard to take it away, and then people start to expect it, don't they? And it does lose. You're right. It loses value. You do a thing every Friday where you buy people pizzas. They just start to expect it, don't they? And then actually it just becomes a norm, and it's not as exciting as it was. It's like apples in the office. When it first comes out, everybody's like trying to get an apple, and then they just sit there going slowly brown, and no one wants them. But I think once you start doing it, you have to keep either keep it going, or go back to the employees and say, look, we've done pizzas every Friday for years and years and years. Is that what you want? And would you like something else? And would you like to try something different? And what could we do as an alternative? And talk to them and see if there's anything that they would fancy. It's tricky, because you're right. You could just keep adding more and more and more and more stuff to this, couldn't you? Just to try and.
Good. Yeah.
Like,
I think running through the
what we've got.
whole of this incentives piece, whether it's financial or non-financial, whether it's a bonus or whether it's equity, is communication actually, and regular, frequent two-way communication between you and your employees. What is it that they want, and making sure that you've got the right incentives tailored to the right people. That is so important.
Yeah, and it works well for us having a social committee, so a committee of the employees who actually sit there and think about this, because it's something different to a survey, having a subset of the employees that can help us innovate and provide new and interesting benefits going forward. Sorry, Esther, cut across you. I shall mute myself.
No, that's okay, because I was determined never to go over. We've gone over by 1 minute. We're done. We're finished. Thank you very much for joining us. Please do complete the feedback poll. Like I said, it's really short. And we will hopefully see a lot of you in a couple of weeks for our next webinar. Cheerio. Goodbye.
Thanks a lot. Bye.